Years ago, it was different. You could buy a stock based on fundamentals. You could buy a stock based on earnings. You could buy a stock based on PE ratios. Those days are gone. That ended with QE. That ended when they financially engineered the market in 2008. Gone. Now you got to follow the money. And we have the knowledge because we have the chart. Pro 2 color-coded chart tells you when to buy, when to sell, when to run like hell.
For a limited time, you can join Phil's Gang free for 10 days.
Check it out, philsgang.com. Get the truth, get the knowledge, and understand how the market really works.
What if you could have an in-depth understanding of the stock market just like the pros? Well, thanks to Phil Grande and philsgang.com, you can. philsgang.com offers comprehensive, up-to-date market information designed to help you understand and anticipate market behavior. With philsgang.com, you'll build your investing confidence even through down cycles and periods of uncertainty. Go to philsgang.com. philsgang.com today. 877-600-GANG. 877-600-4264.
As the new year approaches, make a resolution to challenge yourself to become the best investor you can be. Phil Grande can take your trading to a whole new level. Innovative stock market investing tools and the experience of over 50 years combined to give you the edge in controlling your financial future. As a Phil's Gang member, you're taught the essential strategies of investing using stock charts, training videos, and seminars. It's information Wall Street doesn't want you to know. Learn more at philsgang.com. philsgang.com. If you want to invest your money and grow your wealth, just listen to Phil Grande.
Hi, I'm Phil Grande, philsgang.com. There's many reasons to listen to a radio show, but I think to listen to my show, you get the truth, you get clarity, and you get great information.
No matter what level of investor you are, Phil's Gang strategies for investing are designed to put you on the path to success.
You know what? Most of all, it's fun. philsgang.com. Clarity, good information, and fun.
What does it take to be a successful investor in the stock market? Developing your skills and learning from an expert like Phil Grande and philsgang.com.
It doesn't have to be hard or complicated to learn how to invest in stocks properly. It's like anything else. You're going to golf, or you're going to learn how to play tennis, ski. You need to be with someone. Learn off of them, one-on-one. Now, that can be really expensive, cost thousands of dollars. But I have a program that you can join for 10 days free.
Go to philsgang.com and sign up for a free 10-day trial. Phil Grande has developed tools to teach you how to invest in stocks properly. Not only when to buy stocks, but how to sell stocks short.
85% of people in the market lose money. Get out of that group by just joining Phil's Gang.
Now you can learn to invest like a pro with a pro, Phil Grande. Take advantage of this special offer for a free 10-day trial at philsgang.com.
Try it. 10 days free.
That's philsgang.com.
philsgang.com.
Want good investing advice from someone you can trust? Listen to Phil Grande.
With what's going on today in the economy, especially in the stock market, it gets really complicated, but it doesn't have to be. My job is to make it simple, to get through the fog. And I think I do that, and I think I do a pretty good job of that, especially why you should be buying a stock, or why you should be in the market, or not in the market, or shorting.
Invest wisely with the knowledge of Phil Grande at philsgang.com. Phil Grande has successfully taught tens of thousands of investors how to navigate the market with confidence.
Hi, I'm Phil Grande at philsgang.com. That's right, philsgang.com. Join my gang for 10 days. It's free. If anything, during that 10-day period, you're going to learn how the market really works. You're going to find information that you never had before. You're going to walk away and go, I didn't know that. So join my gang for 10 days free, philsgang.com. And you're also going to learn how to make money when the market goes down. It's kind of silly just sitting there when the market going down, hoping. Why hope?
The stocks discussed on Phil's Gang are not in any way a recommendation or solicitation to buy, sell, or hold. If considering acting on information presented, we first recommend you seek out a competent, licensed professional for advice. Get ready for the radio show that tells you what Wall Street doesn't want you to know.
Oh, I'm a money magnet. Money's coming to me. Money sets me free. I'm a money magnet. Money's coming to me.
It's your your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Radio Network with your host, Phil Grande.
And welcome to my Friday podcast radio show. And by the way, you can catch me every day on YouTube, okay, at 3 p.m. Instagram at 3 p.m., where I do a mini radio show podcast where I bring you up to date as to the market. And in the mornings, also, I do on YouTube where I give you an update or my thought on what's going to happen for the day. In other words, what the market's going to do. To answer the question, what do you think the market's going to do? Well, I do that in the mornings on YouTube, so you can catch that. So you can catch that as well. So we're trying to always keep, Phil's Gang, we're trying to keep you up to speed of what's going on, because all we hear is garbage. And garbage in, garbage out. And then, you know, another thing is, think about this. Let me play this clip. Go ahead, Willie. Play the clip of the president.
If we cut our interest by 1 point for years, we save $300 billion. If we cut it by 2 points, we save, because it's pretty equivalent. We're going to spend $600 billion a year. $600 billion.
Okay, so let's break that down, okay? And I'm not going against President Trump. I agree with him, but I want to fix the numbers a little bit here. And by the way, I know him very well. I'm in his book. If you ever pick up his book, I'm in his book. Which that was a real privilege. And I know how he thinks, and it's always the market. I mean, he judges himself by the market. If the market's doing well, he thinks he's doing well as president. If it's not, he doesn't. But let's get back to what he's saying about the savings, okay? So we're paying interest a day of $3 billion a day on our national debt, $3 billion a day. If he does a 1% cut, it doesn't really do much. A 1% cut would bring it down to $2.5 billion a day. I'm not saying that's not a big cut, but I understand it is, but it's not compared to what they spend. Are you kidding me? And that's the real problem. Everyone's talking about, okay, you got to cut rates, you got to cut rates, you got to cut rates. But remember, cutting the rates got us into the deficits. That's right. The deficits grow when you cut rates, because when you cut rates, and remember, cutting rates is all about printing money, right? And when you cut rates, at some point, what happens is people stop spending because they run out of credit. They run out of money. I mean, there's great demand. When you cut rates, the idea of cutting rates is to get the demand up, consumer demand up. They demand cars, clothing, that. And they go out and spend wild, and they spend on stuff they don't even need and they can't afford. And then when they peak themselves out, it's over. And then what happens is they get laid off because the economy slows down. They get laid off, and the next thing we know, that the government's out borrowing money because they can't collect enough tax revenue. And that's how your deficits grow from rate cuts, see? It doesn't work when you just keep cutting rates, because your deficits keep increasing. And that's not good. But there's $2 billion is not something, and the savings is not. Now there is a savings if we did a 1% cut. Your mortgage would go down $250 a month. $250 a month. So that would help a lot of people too. But again, if you think about what is going on right now, and you go back in time, how this whole mess, how we got here. We can't go forward until we go back and figure out, how do we get here? And how we got here, if you remember, was G.W. Bush, okay? It was G.W. Bush. So when G.W. got into trouble, okay, the financial crisis between 2000 and 2008, to get that through that financial crisis, he had Bernanke drop Fed rates from 5% in August of 2007 to almost near zero, 0.22. Might as well just say zero. by November 2008. Now, and then, remember, on top of that, and that came, remember, at the start of the increase in money supply from 2008 to 2025, that went from 8 trillion to 21 trillion. That's a 173% increase, and that was the start of providing money for 5.5 trillion in increase stock buyback. So my point I'm making is this whole rally that started under GW, he's the one who started to drop the rates because he got into the financial crisis, and then Biden, and then when Obama got in, he and Bernanke said, well, we're not going to continue this, okay, because we understand if we continue this, the deficit will grow. So we're going to do it just for a little while, maybe 3 months, 4 months, something like that. Well, that was a lie because they continued into 2012. So the S&P from 2008 to 2012, because of all this increased money supply and bringing interest rates down to zero, went up 80%. What are you, nuts? And then between 2012 and 2025, because they keep increasing money supply, after QE stopped in 2012, they kept increasing the money supply. And remember the reason for the increased money supply, to fill the banks full of money so people will go and borrow, and they will continue to consume. Demand goes up. And that's what they look for demand going up to make the economy look good, and you get the consumer confidence up and business confidence up, so they spend. But at the end of the day, you pay for all that because at some point it stops. Because what happens, as I just said a moment ago, people get in such debt because they buy stuff they don't need. So that's what started this whole mess. So again, QE, just to go over again, the S&P from 2008 to 2025 went up 737%. But what started this whole rally was 2008 to 2012 because of QE. And went up 80%. Should have never gone up 80%. But that's where our inflation started. That's where our deficit started. And that's where our national debt started to increase going back to 2008. So by the end of the day, 2008 to where we are now, yeah, we rallied 737%, but it wasn't from increased productivity. It wasn't from earnings. It was all fake. It was all from just, stock buybacks and increase the money supply and keep interest rates down to zero. And that drove the stock market. And NASDAQ, 2008 to 2012, went up 160%. Can you imagine? 160%. Then so think from 2008 to 2025, it went up 2,000%. So think about that for a minute. NASDAQ from 2008 to 2012 went up 160%. The S&P went up 80%. So during those years, 2012, the only reason they went up was increased money supply to do what? Stock buybacks, right? And QE. Now remember what QE was for. QE was to go in and to buy bonds to get the interest rates down, to try to get the long-term interest rates down so they're close to the short-term Fed rate, to try to get the housing market going again. So this was all created, this all started with G.W. Bush. And then when Obama came in, he saw the seriousness of this, and he knew that there'd be down the road, we'd all pay for this with huge deficits like where we are today, and you can't get out of it. So, but then when Obama started, he got hooked into the high of all this money, and you keep creating this money supply and keep shoving into the banks, and consumers keep consuming, and he got caught in all that. So here we are now in 2025, and the answer isn't a 1% rate cut. That's not the answer. What are you, nuts? That's not the answer. Boy, wouldn't it be nice? That's it? That would solve all our problems? That would solve our weak labor market? Are you kidding? That's going to solve all our problems. Really? 1% cut? No. It's got to go back to Congress. They got to stop spending, and they got to start cutting, but they'll never stop spending. See, it's the policy is the problem. It's not the 1%, it's the policy. If you could get Congress to stop spending and to get Congress to when they do spend, to make sure it's going to the right place, not like what Obama did. All his spending, remember, went to welfare and to build the welfare state, to expand the welfare state, then go into business investment. So we got into this big mess we're in today, and we're not going to get out of it because we're going to cut rates by 1%. Everyone thinks that. That's why you're seeing today with the stock market struggling. Why is it we now have the highest, okay, in history, S&P and NASDAQ? Well, how come the market can't rally? I mean, a big rally. We should be up. Yesterday, when we broke through the S&P, we should have been up 700-800 points, maybe even 1,000, because that's what happened when you break through all new highs. And this is a gigantic all new high. But why didn't the shorts cover? Why aren't they covering? All the big hedge funds, all the big insurance companies, why aren't they covering? Because see, they believe, like I believe, that this 1% cut is not the problem. The problem is you've got to get your arms around Congress, and trying to get your arms around Congress spending is like putting your arms around jelly. What are you, nuts? So here we are. We're trying to punch up through this all-time new high, and look at the volume. The volume the day before yesterday, right before we punched up, the volume was below average. When we punched up through the S&P and the NASDAQ, the volume was average. When's the last time you saw that? Volume goes ballistic because the short covering hasn't happened. Why? Because the smart money's looking at the bonds. They're looking at the bonds. And what else did they see? We saw in the last 2 days. Anybody's got the bondholders, they're dumping like crazy. People who bought stocks with dividends, dumping like crazy. So I'm not saying the market's going to crash, and don't send me hate mails. Oh, he said the market's going to crash. It hasn't crashed yet. No. If that was the case, then why are we up 20%, 30%, 40%, and all our tech stocks and bank stocks? Our banks, we've been in our bank stocks a long time. We've been in our tech stocks a long time, and our returns are between 20 and 40%. So don't say I've been saying the market's going to crash and I've been wrong. No, not at all. But if you don't start looking forward and talk about it, but see, they don't want you to talk about it. Investors get mad because investors, as I said yesterday, when you hit this peak in time, this is the most dangerous part of a stock market. Now think about it. From 2008 to 2025, 16 years? And you're going to tell people now there's a problem with the market. They don't want to hear it. So they're right now in denial, and they get upset. They don't want to hear anybody talking about the market. They want to believe, close their eyes and believe we're going to start all over again, and what we're going to do again is, here we go, let's increase the money supply again. Let's do QE again. This is what they think. See, that's why everybody's waiting for this rate cut. And that's another reason the market's having trouble to break out with a big monster 1,000-point day or even an 800-point day. Because everyone's thinking, oh, we're just going to start all over again like we did in 2008. We're going to increase the money. We're going to start increasing the money supply again. And we're going to also start, we'll do another $5.5 trillion in stock buybacks. And we'll increase the money supply by another 173%. Like we did back then, 8 trillion to 21 trillion. And we'll do another QE. That doesn't work that way, see? So, and also the market's having problems because the uncertainty of what's going on with the bond market, and then on top of that, you got the uncertainty going on with the tariffs. So if you go and look at, they're telling you how strong the labor market is. I think he said that in that cut, did he? The labor market's strong?
Yeah, the Powell did.
Yeah, play that again. Yeah, this is about the labor market being strong. What are you, nuts?
In terms of the strength of the economy, I would strongly agree. The labor market's in a solid place. The economy's growing.
He's lying. If it was in a solid place, then why have job openings dropped from 7 trillion down, from, I'm sorry, 10 million jobs to 7?
6.
doesn't do that when you're in a solid place.
Want more information on this show? Go to philsgang.com or give them a call at 877-600.
Research Hospital, we're fighting against childhood cancer every day. At the heart of this battle are our donors.
Most of us want to make some type of difference in the lives of others. St. Jude does miraculous work.
The fact that no one has to pay, it's a place where everyone is treated as an equal.
Everybody is welcome here, and it doesn't matter your religion or what part of the world you're from, all that is taken away. It just gives you some hope.
It's just a nice feeling to put your energy into something that really does genuinely make a difference in a child's life.
There's just no greater gift. If we have the ability to help, then we have a responsibility to help.
Finding cures, saving children. St. Jude Children's Research Hospital. Find out how you can help at stjude.org.
You want to invest your money and grow your wealth. How do you invest intelligently? Become a Phil's Gang member and receive the training, advice, and software that will take your investing to the next level. Our team is comprised of successful investors, all with proven track records. Phil's Gang software is easy to use, painless to navigate, and tells you exactly when to buy and sell to help maximize profits. Learn about common market mistakes and how to minimize them. Phil's Gang has successfully taught tens of thousands of investors how to navigate the market with confidence. You don't need to be a seasoned investor to benefit from the Phil's Gang platform, no matter what level of investor you are. Phil's Gang strategies for investing are designed to put you on the path to success. Sign up for a 10-day free trial to see our platform in action, avoid market pitfalls, and start winning with Phil's Gang. Learn more at philsgang.com. That's philsgang.com.
Welcome back. Learn, invest, and make profits with Phil Grande. Simply go to philsgang.com. Now, here's Phil.
In terms of the strength of the economy, I would strongly agree. The labor market's in a solid place. The economy's growing. Inflation is in a pretty good place, come much closer to 2%. So it's a very solid economy.
The economy doesn't grow. The economy's not solid when you're running deficits like this. Again, the national debt grew from 10 trillion to 37 trillion from 2008 to 2025. What's that, 16 years? And interest on the national debt, okay, is $3 billion a day. And if you think about the deficit since 2008, the deficit was what, 454 billion? And what's the deficit today? 2 trillion. Well, why did deficits keep going up then? Well, because number one, Congress, spending going wild. And that's one of the major ones. And the other major one is rate cuts. Rate cuts causes deficits to go up. And he says that we're in a good place. Well, if we're in a good place, then why is it that commercial loans underwater have increased 28% over 2024? That's 200 billion. If we're in a good place, why is it? We have the banks are not disclosing their 515 billion losses in investment securities, like bonds, stocks, so forth. They're not disclosing those. Isn't that crazy? And if we've got such a strong labor market, then why is it the job openings year over year have been dropping from 10 million to 7 million this year? And why is it the quit rate, where people quit, has dropped to 50%? It was almost 80% during 2020. That means people are holding on to their jobs. They're scared. You don't have that when you have a great economy. You don't have cash outs, home equity, rising faster today than in 2009. Can you imagine that? You don't have auto repossessions up the highest in 17 years. Mortgage payments are past due 90 days, the highest since 2020. I go on and on and on. We have 6.1 million people who are delinquent on their mortgages. These are mortgages where they're paying only 3% interest, 3 to 4% interest. And we got 282 regional banks failing. Imagine that, because of the commercial loans, because that's where they go to get them. Now, what do? When you start trading, you block all that out. You block all the noise out, and all you do is follow the money. You don't listen to CNBC, don't listen to any financial, don't read any newspapers with financial. Just do one thing, and you'll make money. Because all we know is the market, they'll keep it going up. They've been doing it for what, 12 years? More than that, what are we talking about? 16 years. They keep driving the market up. And every time we have a pullback, they kick in so much money supply. Look how fast we went up when COVID dropped. And we held interest rates at near zero from 2008 to 2020 or 2022. Do you know 2022, the only reason why we had to raise rates because of the Biden spending going wild. He went nuts, spending this, spending there. So let's take a look at, for example, the stocks that we're working with. So even though we know this is going on, look at the AI stocks that my members are in with me. AI, we got into one AI stock, VST. That stock's up nearly 40% for us. GEV, that stock's up about 28, 30%. So, but it's important for me to know that we have the bond yields going down every day. That's dangerous because that's telling us that the stock market is facing danger. When you have bond yields going down every day, day over day, it's telling you that the economy is really getting worse. And they're going to start having to borrow money. But they can't borrow money from China and Japan, our biggest lenders, because our credit sucks. We got our credit rating was knocked down. So they're going to want big interest. So what do? They'll start selling bonds to folks who have money in the bank. And they'll tell them, how much you got in the bank? CDs and savings and what's your average? What are you getting? So, well, we're getting maybe a quarter point. Well, how about if we give you 4%? Everybody takes their money out of the bank. That's when you really have a problem. Because then the small businesses in this country, that's the backbone of our country. Do you know that? The backbone of our country is the small businesses. They're the engine. They're the ones that provide growth. Not NVIDIA. Oh, we're in NVIDIA, by the way. NVIDIA, we're up big, too. How much are we up in NVIDIA? We're up big in NVIDIA. I think we're, 20%, 25%. But it's not NVIDIA. NVIDIA doesn't bring, they don't drive the economy. It's the small businesses, and they're all in trouble. So when you take the bond market, and you watch the bond market, and this is why we're not seeing this big short covering. Look, the Dow's only up now 227 points. It was up near 500. Now it's down 227. Why? Because investors are not seeing a short covering rally come in. Think about all the big institutions and the hedge funds and Wall Street that have been so short on this market because they know the truth. They don't lie like this guy, Powell. They tell the truth. And I just gave you the numbers. Those aren't lies what I just gave you. That's from BLS. But they won't give you those numbers. They don't want you to know, right? So again, when the bond market continue in the 10-year, just look at TLT. It went up again today. Look at this. This is crazy. TLT, if you want to buy TLT, let me look at it. TLT this afternoon, see what's going on. The bond market, TLT, those are the 20s. Look at this. Look at it, it's going up. It just turned green. They're taking money out of oil, out of gold, and they're shoving it into bonds. They're buying bonds. Look, TLT starting to go up. Look, here it is, just turned green. Now that's bad because that means yields are going down. And when yields keep on going down, what happens? That means that when we go to borrow money because we keep increasing our deficits and we keep spending more than we take in, and when yields keep going down, our lenders see that. They get nervous. They want big interest rates. So the government turns around and starts offering, as I said a moment ago, they'll offer more in the 2-year treasury than you do in the 10-year. That's when your market goes have trouble. The banks drove the market. Look at our JP Morgan. Our bank stocks are up, what, 15, 20%. And that's what the funny thing is. People will say, oh, Phil said the market's going to crash and never crash. He's wrong. Like I'm sitting back here shorting or not in this rally. What I'm saying is that any professional does, they always look out in the future. And there's only one place that you can get the truth, is the bond market. And the bond market tells you, like it's doing now. Here, look at this. Here, take a 10-year treasury. Don't believe me. Here's the 10-year treasury right here. What's that showing you right here? Look at this. Look how long the yields right here. Look at this. So the yields are going down. Look, collapsing. We could end up with a bond. As a matter of fact, J.P. Morgan thinks Jamie Dimon thinks we're going to have a bond crash. That'd be something. Then we go right into stagflation. Never we bypass inflation like that. But in the meantime, I'm trying to say to you, just watch your bond market, believe what it's telling you. It's not telling you the market's going to crash today. It's just telling you that the economy is not strong. And if it accelerates these yields going down, it's just telling you to be careful because down the road somewhere, we're going to have a big correction. That's all it's telling you. But I'm not sitting here and not doing anything because I think, oh, the market's going to crash. Of course not. So you look at our bank stocks. J.P. Morgan, look at that. We got in perfect right here, right in our sweet spot, right there. Our J.P. Morgan. I don't have my sheet in front of me, but we're up, I think, about maybe 10, 15%. And J.P. Morgan, Goldman Sachs. Look at our Goldman Sachs. We got our buy signal right here. Look at that. Went from red to green. Our buy signal, perfect, and it was above the moving averages. Citi, look at our Citi group. Another one took off. Look, we caught the sweet spot right there. Look at this. Look at our Citi group. I think Citi group we're up. Oh, I can go over those later. I don't want to guess, but we're up big in all these. And so our bank stocks are doing terrific. Now, there's only a few tech stocks that are doing terrific. NVIDIA's doing fine, okay? And remember, and Meta's doing fine, all right? And NVIDIA and Meta and MCHP, Microsoft's doing fine. But if you take the Magnificent Seven, there's very few of the Magnificent Seven stocks that are doing well. And remember, it was always the Magnificent Seven stocks that drove this whole stock market. It was always the Magnificent Seven that drove this market, but no more, because the Magnificent Seven are not so magnificent anymore. The last quarter was terrible. This quarter's terrible. And when you look at the Magnificent Seven, there's only really about, Apple's a terrible performer. All these stocks, here, I'll push them up here for you, show you. I'll just get them here in a second. But people think they're still buying the Magnificent Seven. Why are you doing that? Buy the best ones in Magnificent. Don't buy the mags. Don't buy the ETF. So NVIDIA's doing good. That's driving the whole. Matter of fact, NVIDIA, if you take NVIDIA and you take Microsoft and you take Meta, those are the ones that drove the Qs to all-time new highs. But look at this. Apple's terrible. Amazon, okay, is terrible. Look at Google, okay, terrible. Tesla is terrible. So what's going? There are no more magnificent stocks, okay. So as far as our gold and our miners and our GLD and GDX, our miners, we're preparing to sell them short if they break through the moving average, okay? Because what's happening is people are again believe that, wow, this market will never come down again. because we're going to just do what we did in 2008, and we're going to continue to increase the money supply, increase for stock buybacks. We'll do another 5.5 trillion stock buybacks, and we're going to increase money supply for that. We'll do increase money supply for another QE, so we can go out, buy bonds and drop interest rates, and we'll keep, again, printing money so we can give the companies money, public companies, so they can buy their own shares, so their stock goes up, so they don't have to worry about making earnings, okay? So we're in a great place because there's tremendous momentum behind us, and we're riding that momentum with the bank stocks, a few tech stocks, but the bank stocks have been terrific. And we've been riding this nice rally we've been having. So I'm not telling you the market's going to crash today. I'm not saying that at all. But at least you gotta read your signs. You gotta be open-minded and say, okay, what is the bond market? What does it mean? What's it tell you? And then once you discover what it is and what it tells you, here they are right here. So JP Morgan, we're up 16%, Citi 16, Goldman Sachs 20, Nvidia's up 26, MCHP up 48, Mood 32, VST, 32, GEV 30. I mean, I can go on and on. So don't think that we're sitting here on the sidelines doing nothing because we're watching the bond market. So let's get out of our heads that the answer is if Powell will just cut 1%, it will solve our problem. No. What will solve our problem is get rid of everybody on Capitol Hill. Get rid of all those terrible senators up there and the representatives, not all of them, but the majority of them. They're the problem because they want to go home with the bacon. They want to build an ice skating rink. They want to build a football field. They want to extend the runways. And we have no money for that, but that's how they don't care. So now the deficit grows again. And what's wrong with deficits? They kill you. Because when you have big deficits, the sentiment of investors plunge. The sentiment of consumers plunge. So again, to drop this, to drop us from 3 billion a day to 2.5 billion a day, if you really think that's the answer, then you better learn how to sell short because it isn't. Thank you for listening. Join my gang, philsgang.com, and I'll see you on the charts.
You have been listening to Phil's Gang with your host, Phil Grande, on the Off the Wall Street Radio Network. Off the Wall Street Radio Network. Remember to visit Phil's website at philsgang.com. That's philsgang.com. Or call the office, 877-600-4264. That's 877-600-4264.